7.1 talks about adjusting the books. In this section, we're going to talk about what adjustments are and why they're important. And we are actually going to adjust our prepaid expenses and our depreciation of our assets. We're also going to calculate depreciation using two methods. One is the straight line and one is the declining balance. We're going to talk about the principle of materiality and the principle of conservatism. I'm going to try to shorten this up a little bit because it's quite a long. We're going to talk about adjustments, and what happens is sometimes you purchase accounts, you purchase assets throughout the year, but never do you show a place where you actually use these items. So for instance, if you're buying supplies for your office, it doesn't make sense to take every time you take a supply, like a staple, a pen, a piece of paper, to write down exactly what you're using. So what we do is you do nothing throughout the whole year, and at the end of the year, you're going to take, and that inventory is then going to be taken off of your books so that everything is set up and ready to roll for the next year. Okay, so I've kind of already talked about that. Prepaid expenses is anything that you purchase in advance. One of them that we talked about was our insurance is an example. Office supplies is another example. Rent can be another one where you pay a full year in advance and then you take off a little bit every month that you're actually going to pay. Okay, so if I might have to go back here actually and make sure, because it looks like the example is going to follow through, so I should explain it to you. It says the office lease of environmental consulting services requires that rent of $1,700 per month be paid in advance for 3 months. Therefore, on April 1st, a check for $5,100 is used for April, May, and June rents. Because the rent is being paid in advance for 3 months, rent's expense is not debited. Instead, an asset account called prepaid rent is debited. At the end of April, Environmental Consulting Services prepares financial statements that cover 1 month. Should prepaid rent be shown as a current asset with a value of $5,100? The answer is no. After 1 month, 1/3 of the asset, prepaid rent, has been used. The business has used up $1,700 of that prepaid rent. The account balance must be recorded by $1,700 if the asset prepaid rent is to be correct. It is now worth $3,400, not $5,100. Furthermore, since $1,700 of the rent has been used, an expense of $1,700 must be recorded. So we have our asset is going to be credited $1,700, and we have a new account called rent expense, and that is an expense account that has a debit amount. So it's going to look like this. Your prepaid rent is starting with $5,100. On April 30th, you're using up $1,700. Your balance now in the prepaid rent is $3,400. This is going to go on your balance sheet because it's an asset. Because you have to have double entry accounting, you need to have a second account, and that's your rent expense. We know that all expense accounts have debit balances, and expense accounts are going to go on your income statement. Okay, we also do exactly the same thing with supplies. You may have purchased supplies worth $700 and you have $600 worth of it left, therefore your supplies use is $100. It would look like this. Your supplies are going to be credited $100 and your supplies expense are going to be debited $100. And if you take this journal entry here, this is what your T account would look like. Same thing with insurance. You prepaid $1,920, but every month you're going to use $160, and you can see that they're listed here. Your new balance is there. And you see how these ones are matching here. Okay? Okay, so that is the adjustment. thing we have is about depreciation. If you buy a vehicle, every year that vehicle is actually worth a little bit less because it depreciates. Okay, if we are recording depreciation, the assignment of costs or the division of the initial cost over the life of a fixed asset is called depreciation. This process is also commonly referred to amortization. If the initial cost of $36,000 is divided by the life, excuse me, say for 5 years, what they do is they think, how long can we keep this asset and it still be worth money? They think that this item is going to be worth its value for 5 years. So they take the 36,000 divided by 5. So every year on their books, they are going to make sure that they record a depreciation of $7,200. So it's going to look like this. We're going to have our accumulated depreciation account, which we've never had before, and we are going to make sure that we record the depreciation of $7,200 in that account. And then to go along with it, we need to have our expense account. And do you see the word equipment here? That's important. We have a debit of $7,200. Okay, if you want to look at it like this, you look at it this way. You have your asset, which is $36,000 for equipment. You're going to take off $7,200. So do you see how this is a debit, this is the credit, because we're reducing our equipment. And our asset account is going to go up $7,200. So this equipment goes on the balance sheet. The depreciation also goes on the balance sheet, and the expense goes on the income statement. To look at it this way, we have our equipment here minus our depreciation. Our equipment is now worth $28,800. And the reason why we do this every year is because we want to make sure our books are as accurate as possible. And we don't want to have on our books a piece of equipment that we still have it listed as $36,000, but it's actually only worth $28,800. And then what would happen is if you did nothing over those 5 years, at the end, you would have to get rid of that entire $36,000, which would make your books look like they weren't balancing, or would make it look like you had a really bad year because you got rid of an asset worth $36,000. Okay, I'll go back to that page. I've already discussed this with you, but if you're having trouble, go back and read over that. Okay, contra accounts is just an account that lists all of your depreciation. We also want to talk about the word book value. Book value is the amount that if you were to go and trade in that piece of equipment, what you would actually get for it. The banks use that to kind of determine what your asset's worth. And then remember, I told you that there was 2 methods of calculating depreciation. One is the straight line method. Okay, in this method, what it basically does is it takes and it depreciates the same amount over every year. So if it lasts 5 years, it depreciates 20% over every year. So every year it has exactly the same amount of depreciation. And this is what a depreciation schedule would look like. It has your years listed and how much is depreciating each year, and you can see how it's the same amount. This is the accumulation. The first year it depreciates $7,200. The second year it has a total of $14,000, and it continues until that matches the amount of what the item was worth in the first place. The second is called the declining balance method, and I'll show you what this is. It'll look like this. So it's taking 20% of the previous balance. So it's starting at 36,000 in year one. It's depreciating 20% for a total of 7,200. The balance now is it's worth 28,800. This balance then goes into the beginning of year two. In the second year, it's taking 20% of the 28,800, so it's depreciating this amount. You're going to subtract these two amounts. It's now worth this amount. Then this amount is going to come, and it's going to be the beginning balance of what it's worth in year three. Okay, so that's another, this one's a little more accurate, but it's a little bit more figuring to do. Okay, if we were to take these journal entries of the declining balance, this is what it would look like in the journal, and it would have year one, year two, and you see that the amounts in the expense accounts are different every year. Okay, and then the reason why we are showing depreciation is because when we go to do our income taxes, we want to make sure that we have an accurate amount, a balance for what that piece of equipment is worth. And what happens is, for income tax purposes, the government usually gives you a rate at how fast something will depreciate. So if you are having buildings of bricks and stone, the maximum that you can depreciate that is at 5%. If you have buildings with stucco or iron, the maximum you can depreciate that is 10% each year. Machinery and equipment is 20%, and trucks and tractors and automobiles and trailers are 30%. So do you see how the trucks are actually depreciating faster than a building? Because a firm, and it's going to be able to last longer than what you think it's going to be. Okay. Okay, and the rest I think you should be good if you just want to pause or go through that and have a look at that as well.